No, we can't hear it.
And Noah, drop your screen share. And when you share back, click on that audio button as to bring it back in. And welcome, by the way, if you are live on YouTube, and we are live on YouTube, Matt. Matt, we've gotten close to perfecting this intro, but I don't think we're anywhere near there yet, are we?
Well, we wanted to throw Noah to the wolves.
Hey,
He put that Mario background, and I just want to go get an old school Nintendo there, Noah.
I
So,
got one.
Noah is so focused on getting that Mario screen up and running, I forgot to share the screen, share the sound. But, it's a pleasure to be with the halftime crew here today for Tackle Train's halftime report, guys. We've got a great show planned for you here today. Going to be looking at the market skyline, as always, looking at a deep dive into the S&P 500, those major market indexes, crude oil, silver, gold. It just seems, Tim, like everything is bouncing today. We definitely got to get into the psychology of that. It seems like one day we're up on we're down on Monday out of trade fears. We're up on Tuesday. We're down on Wednesday. We're up on Thursday, and it all has the exact same headline, basically. What's your take on that?
Well, it's risk on. Obviously, the market likes the action here today. And, you were talking about this yesterday. So much of the market is just interpretation of the same basic news theme. That U.S.-China trade talk stuff, I mean, it's been 6 months, and on any given day, you go to any major news outlet, it's going to say U.S.-China trade talks or trade tariffs or whatever it is. Today, the market likes the positive move towards what sounds like a conversation. I don't think we know anything real different, Matt.
I think one of the most important things we can do on a daily basis is not just help, our hashtag Team Tackle get prepared for the market on a daily basis, do their daily routine, but also don't freak out when the market is only down 1%, a calming influence, because we've been around these things. And sometimes when you see a day like yesterday and it's, it's not the price action that's the scary thing, Tim. It's the news cycle. When you start doing your routine and all you hear is down, 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 down. And, I was reading some of those headlines yesterday, and they were acting like the market was getting absolutely crushed yesterday, and we're still above support. The trend is still intact. Everything's good. And so I think making sure we help people understand what's going on from a price perspective is equally as important as understanding kind of the overall daily routine we do.
Yeah. I mean, that's the whole point of this halftime show, I think, is really to come in and interpret the news, interpret the action, give a common sense approach from veteran traders. And that's why we brought in our buddy Noah as well. We got the trifecta here today, Matt. What'd you call that yesterday, Cody? The triceratops, the
triple top. What was it? The triple top.
You put it on Twitter. It was creative. It was good.
Yeah. Very cool. All right, S&P 500 in an uptrend. Green candle here today. Noah, that is actually what we call a triggering candlestick. But if you look at pivot to pivot, Matt, we have what could be debated as a slowing momentum. I got a question for both of you guys for clarity. Is the pivot point where we hit the 20-point period moving average about 2 weeks ago, is that an actual pivot point? When you have two candles, do you define that as part of a new range, or is that a larger range between 7-2 early July and early August?
That is going to be debatable based on how you see that as a pivot. I mean, Noah is one of the best technicians around, and I'm going to tell you right now, he might see that as a pivot. I might not see that as a pivot, just depending on how you personally define those things. So Noah, in looking at that specific one, and I believe the date he's looking at here is the 7:30.
7:30.
Yeah, the 7:30 pivot. So yep, right into that range.
Yep.
So basically what he's saying is, if you consider that a pivot, then you have to see this trend as slowing momentum. But if you don't see that as a pivot and you're just looking at the whole range in that latest movement from 2,700 up to 2,850, then that's not slowing momentum. And that's pretty important with kind of strategy selection. So, if you could spend just a couple minutes just kind of understanding what is a pivot and what is not a pivot.
Well, I mean, by definition, it certainly can be called a pivot as a minimum, minor pivot. But it just comes down to, are you really paying attention to those? For me, it all comes down to the context. I think it is slowing momentum, but I think it's slowing momentum into the macro resistance. Like, you've got that big all-time high out there, and I would slow down too if I was heading into a brick wall. Like, people are anticipating that as a big resistance zone. So naturally profit taking occurs. And so I do think that we have slowing momentum here.
Mm-hmm.
in general, but it's still in the context of an uptrend. And I think it's just building up pressure. I don't necessarily see it as a slowing momentum for a reversal. I think it's just more of a, are we going to break through this resistance zone? And if the traders or the buyers step up, it's gonna power on through.
Well, and that's the big question right now. Obviously, are we going to have a breakout? Can we carry through and see that momentum? The skeptic in you, Noah, is because you're an old trader, right? Every old trader who's been around is always going to be cautious and skeptical and need proof and evidence. That would come in a breakout. Now, the green candle today is a strong candle, up 1%, 26 points on the S&P, but it's not a breakout. Now, here's the question for both of you. If we do get a breakout of the pivot high here, if this is slowing momentum, but that could break out, do you buy on that signal?
Well, I'm buying today, and I'm going to buy on the breakout, and I'm going to buy on the breakout of the all-time high. I love the bounce that we had here today, but it really wasn't that, Tim. It goes back to what you and I were talking about yesterday when we were looking at the intraday chart, and we said, okay, if this finishes above, a certain level, and I believe that was 28.20. If it finishes above that 28.20 level, we're going to see that as extremely bullish coming into tomorrow. So I know the headline out there is, oh my goodness, China and the U.S. are going to have low-level talks in later part of August, and Walmart had positive earnings, and there's housing data was mixed. It wasn't good, wasn't bad. It was really kind of mixed. So I see all that data out there. I hear all those headlines, but I just come back to yesterday having an aggressive close coming into the market yesterday. It was a buyer's mentality immediately following the opening first hour of yesterday's trading day. To me, today's candle is just a continuation of what we saw from an intraday perspective yesterday, and I'm taking this as extremely bullish.
I like it too, Noah. I know caution, skepticism, hesitancy, there's no doubt about it, but I've still got a +1 call. I've been slightly mildly bullish for months.
When I say extremely bullish, I'm emphasizing that intraday analysis. I am still +1, cautiously bullish from an overall trend perspective.
Got it.
I didn't want anybody to go out there and pop out of the money call options on the S&P 500.
Oh, come on, Matt. Where's your sense of adventure?
Let's go do some poor man trades right now. Matt's extremely bullish. No, on the intraday off of yesterday, I was extremely bullish coming into today. I am more than willing to come off that judgment with a bad headline coming tomorrow.
Interesting.
Technically, I'm just taking this as bullish, guys. Intraday to today, strong movement.
Yeah, you have upward moving averages. You have strong action. You have a green candle. You have a breakout potentially developing, but you do have that all-time high looming, which is where that extreme mild conversation probably brought us back to mildly bullish or moderately bullish.
I don't know, guys. I see that all-time high. The NASDAQ didn't care about that all-time high.
I agree.
NASDAQ, guys, think about it. And I certainly agree with Noah that it's slowing momentum coming into a building pressure. I agree with that 100%. But this market, how many all-time highs has this market set in the since 2013? Hundreds and hundreds. So yeah, I agree that it's a target zone, no doubt about that, 100%. But I do expect a breakout.
For sure. No, let's go through every one of the major indexes, Dow Jones, NASDAQ, and the Russell 2000, like we do each and every day.
Since Matt just brought up the NASDAQ, let's hit that first. And that also has a slowing momentum pattern, even though it's just challenging a minor high, not like a significant high. But it's still everything being said, I think that's still a beautiful upward trend. I'm expecting that to break higher too.
Would you call yourself an Elliott Wave type theorist?
I used to be a hardcore Elliott Wave theorist, and then I gave that up for Lent.
Because wave 5, Matt, is that where this is right now?
No, what I said yesterday, Noah, is if you take this short-term trend, it is pretty accurate from an Elliott Wave perspective.
Yeah, 1, 2, 3,
Thank you very much.
5, 1, 2, 3, 4, 5.
That's all I said, and I was teaching that, typically after wave 5, we go into a consolidation continuation pattern. That's what we're seeing here, fully expected to break out.
So, and I'm asking, so here from wave 5, usually we have this high base, and then a breakout could create a pretty big move from here, Matt, based on that theory. Is that right?
Based on that theory, I mean, if you break out of this level right here at 7,500, 7,530, you're starting a new trend,
a new wave count,
And based on Elliott wave, that is a perfect time to get into something from a position or a trend trading perspective, where you try to take advantage of the entire trend instead of just a single price movement within that trend.
Yeah, yeah. So here's the question, I guess, and where I'm going with all this is, if we catch a breakout on the NASDAQ, Noah, would you rather play the NASDAQ, or would you rather play the ES? Because the ES has balance in the overall market. The NASDAQ's mostly tech heavy.
Well, I have no problem going with the NASDAQ because, it's tech heavy, and that's typically what's been leading the market. I like the balance of the S&P, but I do not have a problem pulling the trigger on the tech stocks. I even probably skip the NASDAQ composite and go straight for the big dogs, like Apple breaking out.
Yeah, Apple breakout today is
we'll look at that later.
Definitely a big deal. Take a look at the Dow Jones. Part of the pressure from all this China-US trade talk stuff, Matt, for the last 6 months has put pressure in industrials at different times. When the news is negative, these industrials get hit. But like today, when the news is positive on that front, the industrials can lead. Right now, the Dow Jones is actually leading and closer to a breakout than any of the other areas. That 25, and what is that exact high of those bodies there? No, about 25,
about
650?
25, 660 something.
Yeah. So we've got the overall market, S&P, then you have NASDAQ showing so much strength long-term, but then here are these industrials. And I know one of our favorite stocks, Boeing, on our Tackle 25 watch list, is bouncing off the bottom. You've got a bunch of companies here. Matt, how do you interpret the Dow's strength here? Is it just a reaction to the news, just more of the same that we've seen?
That's the Chinese headline.
Mm-hmm.
That's the Chinese headline. It's the continuation of the intraday movement from yesterday, like we talked about. But the industrials is really kind of in the line with those tariffs and the trade wars and whatnot. And so this is just positive news coming to the entire sector in the industrial sector. That's how I'm taking it. Mind you, by the way, just some random thought here. I want to get you guys' take on it. Back in the crash of 1987, the Dow dropped more than 400 points. Okay, it was the biggest percentage one-day drop in the history of the U.S. marketplace, created massive panic where over 200 savings and loans companies went basically bankrupt, and created a massive recession. Today, the Dow Jones is up 369 points, close to what it lost on that one day, and it's just a normal day in the marketplace.
Yeah,
it's a different marketplace, and I was also in high school, so
Well, my point is just the perspective of things as society evolves, right? I mean, right. A percentage movement in the market today was a massive movement 20, 30 years ago. It just makes me think about how much money we printed in the U.S. markets over that time frame.
Sure. In that whole period, I know that back in 2008, we were all traders. And I remember some of those days, Matt. It was panic on the street. And so when we get these red candles like we did yesterday, where you're down 1%, none of us really look at that and say, oh, panic, right? Because we have context. A new trader, when the market is down, I'm sure they're over-interpreting that. But you're right. I mean, 360 points today on the Dow, and people don't even think about that part anymore. Well, it does come back to percentage.
Well, it's also the reason I bring it up is because of yesterday. Yesterday the market's not even down 1%. People are freaking out. Have some perspective historically.
I got Noah chuckling this morning, basically making a case that Ben Bernanke was a great American patriot. So
it makes me laugh even the second time.
Ben Bernanke was a coward and he was weak.
Oh, he's that academic type. And
no, I don't want to miss. He was cowardly in how he approached the subprime market crash. He was implicit in it. He was implicit in it with his policies. He was an accomplice to Wall Street. He did nothing to regulate the Wall Street banks. He sat on his hands and did absolutely nothing. In February of 2008, he gave a speech where he said the subprime market was resolved. The housing sector that was doing good. Automobile sector was starting to see a pickup. 2 months later, Bear Stearns had to get bought out by J.P. Morgan in one of the biggest bailouts that has ever happened, funded by the U.S. government through taxation. 6 months later, Lehman Brothers is out of business, and he knew everything. He lied to the consumers. He lied to us. He is a horrible individual who is complicit in one of the biggest crimes I've ever seen. The just theft Wall Street took of every consumer's retirement account in 2008.
So
Why don't
Great
you tell
American,
us
Great
how
American
He was not a
Patriot
great American.
Great American Patriot is not how you feel then.
That's not how I want to approach Ben Bernanke. No.
You know what's interesting based on that history, though, and we'll table this for a podcast for sure. But that whole thing with quantitative easing and all that money they created, it may have changed capitalism. I don't know if they can come back from it because of all of the money creation that has been pushed into the system. And
capitalism died in the 1980s.
Yeah.
What happened with Ben Bernanke was an extension of the neoliberal policies of the 1980s.
Yeah, I agree with that. Dow Jones Industrial showing a ton of strength here through almost a 400-point move. I like the industrials. By the way, for me, if I'm going out scanning today after I look at the first three indexes, Noah, I'm probably looking for tech strength and I'm looking for industrial strength. Would you agree with that?
Yeah, and there's a couple other sectors that are doing pretty well as also. But yeah, those would be very solid sectors to focus on.
Let's take a look at the RTY. Obviously, the small caps are the last one we always look at. Little baby brother here stuck in a range, but what was that? That was a great tweet, Cody, and very creative, very funny. I loved the dinosaur that you drew. What was it called? A triple top triceratop something? I can't remember, Matt. You remember?
Triple
three toposaurus.
Three toposaurus. The old three toposaurus with the body and the head and all that.
So they created a new pattern.
I think you got to give Coach Gino some credit on it, but because I think that's where you
like this is a three double top, triple top, three top something, and Cody's like, "Yep, okay, let's go with that."
Oh my God, this is too funny.
There you go, Noah.
That is perfect.
Perfect.
Get some fire, Noah. Come on.
Somebody screenshot that. Oh my gosh. Unbelievably cool.
That's how I feel about trade tariffs.
By the way, if that triple toposaurus opens his mouth, that will be a break.
Yeah,
Tim, that would be a breakout if he opens his mouth. Looking at the Russell 2000 here, why we get Tim frozen on the screen. This is always funny. But there we go. But looking at the Russell 2000, though, obviously one of the weaker performers, in terms of relative strength over the last few weeks. Tim and I have talked in the past that if the Russell does break out, though, it can run fairly aggressively. Would you agree with that?
Oh, absolutely. In fact, I think it has benefited most. It will benefit most from a lot of the policies. The tariffs may hold some of those, but it's protectionism, and most of those Russell companies are inside the U.S. They're not multinational corporations. They're the inside the U.S. corporations that benefit from the protectionist policies.
And would you also agree that whenever you see a very strong dollar, like we're seeing here right now, that the small and the mid cap stocks are not as prone to the importing, exporting problems with the strong dollar?
They're not. They're going to face it the same way like a Caterpillar or a Boeing will, because if you have a strong dollar, that decreases purchasing power from the people you're selling to. So it makes our goods and products more expensive, obviously.
But if you're selling primarily to U.S. consumers, like more small and mid cap stocks are, it's not going to impact them as much.
Right, especially if they're importing, products and goods and services to sell, then that also I think benefits them because their purchasing power is far greater. So yeah, it certainly benefits the small and mid cap companies more so than the multinational big boys.
The reason I don't think the Russell's breaking and running the same way like the S&P, the Dow, and the NASDAQ are, is really there's not a whole lot of risk out there, right? And I just feel like that the money's coming into the big companies right now. Look what's happening with Apple right now. Would you rather buy Apple or a small and mid cap stock right now? Apple's breaking out, right?
I could buy both.
Breaking out.
Why do I have to choose?
Well, you don't. But if you're doing portfolio allocation from an institutional level, you kind of have to choose, right? As a trader, we'll just go, throw our darts and, do whatever we want. But I do see money rotating into those blue chip companies a little bit more than the Russell 2000. I still have it ranked the same way I've ranked it for the last little bit. NASDAQ 1, S&P 2, Dow Jones 3, Russell 4.
If you take it from the start of the year, I mean, we open up the year at 1540. It's at 1690 right now. It's still up 150 points. It might just be time correcting as well. I think it's currently in number 4, but I would quickly, like we talked about several times, I would move that way up the list if it broke out. There's no doubt.
Absolutely. Oh,
Yeah.
absolutely. And I still believe that we're in bullish territory. The market wants to buy. It still has this buy any dip mentality. And yeah, we're in a late stage bull rally, but that's years in the making. We're talking over the next few months. If you guys, and I'm going to put you guys on the spot, and I'll answer as well, but coming projecting out, the rest of the year here, the Russell's up 10%. The markets are doing fairly good year to date. Do you expect a rally coming into for the rest of the year?
I don't have a problem seeing a strong fourth quarter. I'm always a little cautious about the market in September because that's if corrections do occur, they start in late August, early September. But usually by October, the market's going to be relatively bullish. I mean, typically by October 15th, you're starting to see the beginning of a rally.
I'm more bullish now, Matt, than I was at the beginning of the year.
Me too. I am as well. And coming into the year, I was
cautious. I remember our prediction podcast. I literally said, we're at the late stage of a bull run. We might have a correction.
Oh, I was completely wrong on oil and the dollar and gold, but I was pretty aggressive on the stocks. And so even though I was fairly aggressive on the stock, I'm more bullish today than I was on January 1st.
Me too. Now, that being said, and here is a mindset thing, and this isn't a disclaimer, this is teaching. I'll tell you, we are willing, and you know this, Matt, we're willing to change our mind tomorrow.
I mean, yeah. If Trump tweets and says we're putting $600 billion of tariffs on Chinese goods coming into the U.S., yeah, I'm going bearish.
The whole thing with trading is that you have an ongoing conversation about what the market is doing, right?
Of course. The prediction podcast, we do it for fun. But I mean, from a U.S. valuation perspective, we are slightly overvalued. Would you guys both agree with that?
Oh yeah, from a valuation standpoint, but you're assuming people behave rationally. So yeah,
no, they don't. They absolutely don't, right? But from a pure valuation, the CAPE ratio is what, about 29, 30
based
right
on
now?
historical measured, we're overvalued.
Okay. So would you also agree that economically in the U.S., we don't have that many concerns economically right now?
Yeah. I mean, you got 4% unemployment. You have strong consumer sentiment. You have the biggest concern I have, frankly, is the low savings rate. The fact that so many people, you could have a fiscal crisis in that regard, Matt, if you went into some problems. But that,
okay. So fundamentally, we're okay.
I agree.
Technically, we're okay. Economically, we're okay. The only thing that could put a damper on this bullish parade we've had is tariffs and geopolitical politics and the emerging market crisis, right? And that's not a lot we have control over. So from a technical, fundamental economic perspective, I am bullish right now. But the thing that can turn that all on its head is the things that we don't know. And what we don't know is those unknown variables of how that trade war is going to kind of play out, if it's going to escalate, de-escalate. How many times have we seen something escalate in one day and decelerate the next day? Just this year so far.
Yeah.
I mean, so economically, fundamentally, technically, I'm bullish, but I am cautious because of those geopolitical situations.
Well, this kind of makes me think of a conversation I've had many, many times with a lot of different traders. We're building a bubble because they go through bubble cycles. Do you agree that we're continuing to build the bubble?
Yes.
Yep. Then the question is obviously we don't know what pin pops the bubble or what what's going to be that catalyst. The one that I think I've been thinking about the most or worried about the most is just the insolvency of Europe in general.
Sure.
And not that the U.S. is any more solvent, but we kind of make the rules.
To paint that picture real quick.
We have more ammunition.
To paint that picture, put on the S&P 500 and pull it back to like a 20-year weekly chart. Because if we're going to discuss long-term market cycles and bubbles and the potential for it to pop, I think this visual can be very powerful. The 20-year monthly is fine. And you may need SPX. I don't know if the ES data goes back 20 years.
Oh, it does.
Does it?
We can go SPX here.
Either way.
Man,
now, when you
ahead.
just look at the picture, we've been going up for 10 years.
Yeah, it's the second longest bullish market in the history of the U.S. markets. I mean, and honestly, guys, I mean, yeah, if you look at that daily chart earlier this year, it looks a little nasty on the daily chart, but we're not slowing down, guys. We're breaking out.
We're breaking out of long-term resistance in a low unemployment, strong earnings, low tax environment. I don't know if I'm maybe I'm not bullish enough, quite frankly. Matt, maybe a lot of this caution comes back from,
the caution comes back to us understanding Fed monetary policy. That's
Sure.
where the caution comes in. Rising interest rate environments typically have a tendency to slow markets down. Noah speaks of those unknown catalysts. The catalyst happens, sparks massive market panic. Panic creates this volatile situation where they can't withstand the fear building up. Things escalate very, very quickly. Markets are down 20% overnight. That's where the caution comes in, right? Because we've been there before when we've seen these unknown events happen to trigger something tremendously bearish.
And you're right, Matt. And in hindsight, you look at some of those previous market meltdowns where we watched what happened. We watched all the money. You mentioned 1987. They all kind of look like blips on the radar now from a scale perspective. And when you have those easy money policies, it certainly is going to cause that to accelerate. I think it's one of those things where you trade what you see, and that's clearly bullish, but not what you believe, which we all know is what I think creates that caution.
That we know it's fake. No,
so that's the thing, is we know that. So you're ultimately cautious, but isn't that why we use stop losses and position sizing?
Absolutely,
but risk management. Yeah,
I'll tell you, Noah, looking at this, speaking of perspective, think back to 08, 09, how nasty it got.
Oh yeah.
I mean, end of the world. That looks like a bullish retracement in comparison to the bubble we are currently going in right now. I mean,
I want you to think about this. Think about like the Fannie Mae, Freddie Mac, easy money lending policies led to this.
05, 06.
That little move right there, and the outcome was that crash. So this entire move has been the easy money policies.
It really was that exact same. You're so right. In 05, 06, having they were stripping down these regulations after Glass-Steagall got taken out of the equation in 99. They're stripping down regulation after regulation after regulation, and it's all about selling derivative products. And so all these regulations that came out of the Glass-Steagall Act, they're getting stripped. AIG, Bear Stearns, Lehman Brothers, Goldman Sachs, JP Morgan, Sallie Mae, Freddie Mac, they all start creating these massive derivative products because they never thought that housing would ever slow down. The moment it slowed down, showed the risk in Bear Stearns. Bear Stearns got to get bought out by JP Morgan. That sparks a panic. It then hits Lehman Brothers, then hits Merrill, then hits JP Morgan, then hits Goldman Sachs, and you create this massive panic. And so, yeah, it can go fast, guys. That's why we're cautious, despite the fact that we're going through a massive bull market.
It's too big to fail. Maybe this market is feeling like that too big to fail type of market as well. To me, I could sit and talk about the overall context of it forever. The one question I'd have for everybody, and I want you guys to think about this. Noah, you started bringing up insolvency in Europe, and Matt, I think you understand the quantitative easing stuff and Fed policy better than anybody I know. But I want our halftime crew out there. What's one thing that you think could pop the market? I'm bullish. I'm not changing. I'm not coming off of that until other evidence come in. But what is one thing that could pop the market? Let's go to Matt first.
One thing, one variable?
In
a million different variables?
Yeah, it could be anything.
I don't think the bubble will be popped by earnings. I don't think it'll be popped based on economics. I think it'll be popped based on trade wars. If it does get popped, I think the trade wars escalate. I hope that doesn't happen.
Noah?
I'm going to hopefully say we don't wind up in escalating trade wars to actual wars. We wind up with you got some struggling emerging markets, and those struggling emerging markets will, cause a trickle effect to the financiers.
Well, I mean, that's a good point, Noah, because think about it. One of the biggest problems in 08 was the exposure AIG had to the international community. And once we started seeing the problems with Bear Stearns and Lehman Brothers, AIG, I mean, those were pretty much investment firms, right? They weren't traditional banking firms. But so if they fell, they fell. They're an investing firm, right? But AIG was not. They're an insurance conglomerate that basically was selling derivatives to every other bank around the world. And so, France, Britain, China, Japan, Australia, they all had significant exposure in AIG. And once AIG came out, I mean, it basically sparked a world recession, right? Mm-hmm. And so that certainly can happen. It's a wonderful point.
Oh yeah, well, if you want to read an interesting book on the topic, go read Boomerang by Michael Lewis.
I like
it just talks about how the derivatives really exposed the other banks, the banks who thought they were investing in good stuff and didn't even realize the exposure they had. And I think that's what I see with the emerging markets is, the big global banks finance those emerging markets. And if they're not able to produce and repay their debt service, that becomes the contagion.
Well, I think one thing though, with all that, well, go ahead, Matt, you finish your thought because I have.
Well, we say the word, I was just going to say the word derivative. When we as a trader think of the word derivative, we think of options, right? We think of trading options, buying calls, buying puts, selling calls, selling puts. That's not what Wall Street is selling when we say the word derivative. When we say the word derivative, it is a product that they create off another existing product, which means it's usually a bond-based product that is backed by the value of something else they own or something else they've sold, such as student loans, car loans, retail loans, business loans, housing loans, whatever it is. And so AIG is basically selling these insurance products that are basically protecting the value of these other derivative products in Wall Street. And then Wall Street, and especially Goldman Sachs, comes in and bets against AIG's insurance products. Once the housing market falls, everything falls, and Wall Street makes bank in those types of capacities. And I see something similar that is going on right now. And so I just wanted to quickly describe what the term derivative is.
Yeah, and it's a huge market, by the way. And those private institutions on Wall Street firms, they don't use the public products we do when we buy and sell calls and puts. They price them themselves. Got a couple of from our halftime crew, by the way. If you're out there watching, thanks for being here. Give us a quick like and share. Everybody, hello. We're about halfway through our halftime report. I think if there's one thing that could pop the market is if the super volcano in Yellowstone blew up, that would definitely make the market go into a bear market, Noah.
So what you're saying is I need to go to
infrastructure spending.
There you go. Yeah. Let's take a look at crude, gold, all the different commodities moving through the market. Let's look at the VIX first here, Noah, and go back to a daily chart. This is Matt's favorite indicator lately.
It's the stupidest indicator.
He hates it. He hates it so much. Noah, have you used the VIX much in the last couple of years? Do you just kind of glance at it? Is it old?
I look at it I already have an idea in my mind what it's going to look like. It's kind of like the little MACD indicator I've got on the bottom of my chart. I could draw it for you if I could see the chart. I know what the VIX is going to ballpark at. What I'm interested in is the number, so I get an idea of what kind of volatility is being priced in. I don't think it has any predictive value whatsoever because it just tracks the S&P. So whatever the S&P is doing is really going to indicate or dictate what happens to the VIX.
I just look at the S&P.
Yeah, I don't trade it. I don't trade any of the ETFs or any of the derivatives off of it just because you're going to make money off of a market crash. And I don't think most of the ETFs and things are wired correctly. There's some weird wiring as far as how they're leveraged, and they don't move.
I think Noah's in my camp on this one.
I think so. By the way, we've got more feedback over this VIX conversation. People loved your take on this, by the way.
Well, we sit here and talk about it every single day, but yet not one time does it actually indicate what we should do from a trader's perspective. I think it's a completely worthless indicator.
What always tells me that after I look at the VIX, I need to look at crude oil, which is /CL up here on the top left. Let's take a look at the commodity market.
You know what? There's something to be said about that habit of looking. It just keeps you in your
routine process. That's just me. It's what I do. And I think every trader does that. We all have our habits. We all have our checklist, right? Table the conversation for another podcast. Maybe we'll deep dive. We'll get all the VIX experts in there and we'll get a round table going.
You're going to do that podcast with somebody else because I'm not showing up.
But what would we do without the rent?
Yeah, it's true.
You guys can sit there and talk about how the VIX has changed your life. Yeah, you never do anything with it.
65.35 on crude oil. Little green candlestick here, but we're broken below support at 66. Now I want a technical read here. You have 66 that was support on the short term, Noah, but now you've got 64 that was the old pivot points in May and June. Are we at support? Have we broken support? Are we in no man's land? Are we
Got a
neutral?
big support zone here, but just looking at it from this perspective right here, I don't think we're still in the uptrend territory. We've broken one pivot, and here we are sitting at the next. And if the dollar's rising, I continue to expect oil to drop.
Hey, Noah, do me a favor. Add the 200-day moving average real quick.
No.
It might change. It might change the
Might change
analysis.
okay, all right. Let's throw up that 200 period simple moving average.
You know, I do this a lot when I'm looking at previous levels of support, looking at a target. I'm like, okay, now you add up the 200-day, and you're like, might change the analysis just a tiny bit.
It might, but it also might.
It's still bearish. It's short-term bearish. I don't care where the 200-day moving average is.
Okay. It's at the 200-day moving average, which I think will cause your short-term buyers. Yes.
Yeah. But with the same thing said, Noah, it'll break that 200-day with nothing with, you know, if it wants to. It's just going to cause a little bit of buying action.
Yep. No, you're absolutely right about that. And I mean, it's, you know, this is one of those things where who do you give the credit to? The 200 period moving average or the support zone it's sitting at?
People who like the 200-day moving average will give the credit to the 200 period moving average.
And since I didn't even have it on my chart, I'm just like, bounced off support. You know,
either way, the analysis is similar. You're sitting at support, but the overall trend is bearish, but you are sitting at support.
Correct.
You know, one time I went back and looked at 90 years of data on the S&P and how the market reacted to the 200 period daily moving average. And this old belief that it hits it and bounces is just absolutely crazy. It doesn't always hit it and bounce. It sometimes will dip below it a little bit and then rally. Matt, that's more of a zone of support, isn't it? You know, it's not necessarily an exact decimal point.
Well, no, support isn't an exact decimal point. You know, and mind you, you don't know the 200-day moving average is going to act as a support level until the future has determined that. Mm-hmm. You know, the way I was describing it is, you know, to actually have that confirmed as a support zone, you need about 3, 4, 5 trading days, right? And so you can sit here and you could wait those 3, 4, 5 trading days, and if that does, and if over that 3, 4, 5 trading days that does confirm as support, well, that's fantastic. That didn't make you any money because you can't make that trade anymore because it's already bounced, right? So what we're looking at here is not actually the definition of support. What we're looking at here is actually the definition of what a support catalyst is. And moving averages, previous levels of support, those can be catalysts that can now in the future behave as a support level. Some are stronger than others. The 200-day moving average is a widely tracked long-term investor perspective. On the S&P 500, I'd challenge you a little bit because on the S&P 500, I've seen that hit the 200-day moving average many times and bounce. But yeah, you know, it certainly can break it, dip underneath it, because at the end of the day, support, we might say 64 or 65 or 66, but we know it's a zone around 64, 65 or 66. You just got to give it a number. So if you say supports, you know, what's that 200-day moving average exactly? 65.35, right? So if you say it's at 65.35, I'd say you're an analytical person that you're going to drive me nuts with your data because I would just say 65.
Well, you know, I agree 100%. Everything you just said, I agree with. I think my only major point is that when I see people get all worked up and start screaming and all that kind of stuff, if the market goes 1 penny below some magic line, no. Like, come on, guys.
Heavens, no.
Get some context to the thing. We're at a zone of potential support. I go back to the commodity report I did last weekend. I am short-term neutral, long-term bullish still, Noah. So I do have a different take than you, and that's okay. That's why we have a market, right? We can have different opinions on it. I just wouldn't touch it right now until we get confirmation. So zoom me in there a little bit, Noah, and tell me what would have to happen in terms of confirmation. Do we got to break 70? Do we have to break the little pivots there at 68? Where would confirmation come in?
I think you need to clear that level first, and then
it's getting back above 66. Noah, would you agree? Is that right where that kind of level is?
And we may take our turns freezing here today.
Yeah. So I know it's coming back in here. I would say that level is you got to get back above 66, kind of where your old support level was first. I do think you can trade it directionally above 66. It would be aggressive, though. I think the purest technical, you know, swing trade here is still a breakout of 70. I don't expect that to happen in the short term in any capacity. This is still showing weakness.
Yeah, Yeah. So one of us are going to have to grab this screen share here, Maddie. Do you want to
I
do it?
just want to see how long we can keep Noah frozen. It's always funny when especially when you're looking head on in your freeze, and it's like, wow, yeah, that's how it's done. Let me go ahead and share my screen, Tim. Just give me 1 second. I mean, what's your take though? If you're long-term bullish, Tim, on crude and sitting on the 200-day moving average, that is a buyer's zone for a long-term position.
Yeah, I'll go back to what I said in the commodity report. To me, you've got strategies you can play. Yeah, not long call. You could buy ETF with protection. That would make sense to me, and start doing cover calls and that kind of thing. Moderately bullish. If you're an advanced option trader, I like the call ratio back spread. Now, I know that's not for every strategy, and not everybody knows that kind of thing. But I like the idea, Matt, of having some downside protection, either through a protective put against the ETF or some kind of natural protection in the spread. If you want something simpler, you could do a bull call spread, something like that with confirmation.
Every trader's going to approach it a little bit differently. Tim, can you see, how's my screen coming across on YouTube?
Beautiful.
Okay. Every trader's going to approach it a little bit differently.
No, not beautiful.
Oh, hold on. I was looking at Zoom. Yeah.
Okay, so let's stop sharing. Share for some reason every time I have to do that.
Yeah, it's usually just that first time that fixes it automatically.
How's that work now?
Yeah, there's always a little delay. Cody, you let us know.
Okay, so what I was saying here, we've detailed that. We've detailed that trade that I made right here on crude, the one that I ultimately I made it. I don't know if I lost a little bit, broke even, made a little bit, but it was basically nothing. Ever since that time period, Tim, right into this range right here, I kind of shifted and I started selling put options is basically what I did. And so, I went out deep out of the money all the way down underneath the 58 contract here. So that's how I approached it. Every trader can approach it some way different. Now, when I say put options, I did the bull put spread. It's basically, I did the bull put spread on the futures market. So, looking at that, you can approach this a lot of different ways. From a long-term investment, you're sitting at the 200-day moving average. That's a buy zone from a long-term perspective. And those types of things I kind of like. You're picking up something with very little risk. You have a stop loss right underneath the 200-day moving average. That does make some sense to me. There's just no swing trade here, Tim, in my opinion. And I don't think there's a swing trade here for a while.
Yeah, I'm with you. Because even a call ratio back spread is more of a position trade, Matt. If you're going to take a stab at crude oil, you're probably going to look at maybe a 1 or 2 month trade, like naked put, like a spread, something like that. More on this one as we go every day. Obviously, I'm still waiting for some confirmation. Long term, I'm very interested right now. The big thing is that strong dollar, though, and Noah is right. He brought up a very good point. The thing that could throw crude oil for a lurch is if the dollar continues to rally and show extreme strength, Matt. If it's up another 5% from here over the next 2 months, which would be a pretty good move for the dollar, there's no doubt about it, crude oil could take it on the chin eventually.
Yeah, well, it certainly could. And again, I just come back to, that being something that we're seeing decoupling. And so we've seen the dollar and we've seen oil rise together. We've seen the dollar, we've seen oil drop together in the last couple of years. And we're seeing that decoupling happen more and more and more. I mean, year to date, oil's up and the dollar's up year to date. So, I'm not 100% convinced that even if the dollar rallies, oil has to get crushed, because I do see that as a long-term, situation that is kind of coming apart. I definitely agree that, the precious metals will get hit if the dollar continues to rise, but I don't think oil going down is a direct correlation is my whole point there. The dollar's showing strength. I mean, it's overextended right now. I don't see a trade potentially on that, but this dollar is strong, and it's as strong as it was in 2014 coming into 2015. I don't see anything in the economics or anything in the geopolitical situation that is going to stop the strength of the dollar, especially if Jerome Powell continues to be aggressive with his Fed monetary policy. Rising interest rates shows demand for the dollar, Tim. And unless those other currencies out there start aggressively raising interest rates to offset the dollar, you're going to see the dollar continue to go up, and you're going to see the other currencies continue to go down.
I think it's the story of the summer, quite frankly. Well, I don't know, earnings on the market beating 80% of the companies beating earnings is the story of the summer, but the dollar breaking out is the bigger investment, Matt. I mean, it is the biggest product in the world.
Oh, the dollar breaking out is definitely the story, but the story is going to be tariffs. I mean, that's the story. Positive earnings, positive economics. Honestly, Tim, most people have already moved past second quarter earnings. Most people have already moved past the economics from last week. It's the story of 2018, and the story of the summer is going to be the escalating conversation from a tariff discussion.
Yeah. All right. Very good. Let's go through a bunch of different, stocks after we look at gold and silver. I've got a big list. We'll go rapid fire style, Matt, but let's talk metals for a minute. Obviously, when the dollar is moving, metals are going to move. From a candle perspective, you got to like it, but gold is still weak. It's still very bearish. I don't care if that is a hammer candle or whatever you want to call it. It's not quite a hammer yet with the small body. Is that right, Matt?
Hey, all I said, I'm going to say the same thing I said yesterday, Tim. Watch gold rally. Watch the gold bug say it's coming back right up into resistance, and then every one of us are going to short it.
That's right. I think any rally is going to be met with some very serious interest on the short side.
Serious resistance.
Yeah, you've got a downtrend. You've got old support. You have many different catalysts that could serve coming down. And interesting in the metals market, silver from a relative perspective. If I was going to buy coins, I said this many times, I'd go do the silver coins here. Noah looks like he just landed from Apollo 13. Now he's
now I can go anywhere you guys want with this. This is good times.
Yeah, that's pretty cool.
I need Noah's technological and creative savvy. I need that, Noah.
You've got it technically. That's how that works, right?
Yeah, thank you for the fun. I like that. No, we were just looking at analyzing gold and silver. Honestly speaking, what's your take on gold and silver?
I've just been scratching my head trying to figure out why it's selling off. Because I don't know. I just look at it. I see the dollar rising. I understand all those reasons, but I don't ever really understand this idea of selling gold. I'm glad it's down because it just makes it cheaper to buy. And it just makes me want to run out and buy physical while it's on sale. It's like, attention Kmart shoppers, physical silver on sale. That's what I think.
Yeah. Well, it's down because people are selling it, right?
But why are they selling it?
Is that kind of like Noah saying, well, technically you have it?
Yeah.
I think that was the same thing. I don't disagree on that, Noah. I mean, buying precious metals as the market is down, I'm always on board with that. But from a paper perspective, you're not buying this from a paper.
Oh no, not a paper perspective. This is one of those.
Probably shorted it and bought put options on it.
No, I actually didn't touch it, but I should have. In hindsight, it's just that gold can go lower, but I have one of those thou shalt not short sell gold.
I have a hard time with it too.
Yeah,
I don't have that. From a trader perspective, investor, I mean, I'm gonna buy metals and hold metals. There's no doubt about it. But if gold is breaking down, I will trade it. And I do not have any problem with that. By the way, if Walmart's breaking out, I will buy it as a trader. It is what it is.
I have a hard time buying Walmart.
I will get to Walmart here in a minute. I think the company's making some good changes. I really do. I've been talking about it forever. I get teased about it because Walmart's that boring old dinosaur, but they are doing some really good things right now, Matt. And they had earnings last night, and the market definitely loved them. As we go on to some of these different companies, Matt, Walmart gapped out from 90 to 98. Now, it's been in a reversal pattern for some time. There are several numbers that stood out to me. Number one, the earnings number, obviously top line, but their bottom line numbers on revenue are incredible. They make incredible amounts of money. They bring in a lot of money and they actually make profit. I don't know. What's your take on Walmart?
I think that was a shot at Amazon.
It was a shot at Amazon for sure. I think the discussion between Walmart and Amazon is a real one. Everybody loves Amazon. Obviously, I do as well. I've been saying you can buy Amazon any day and you probably have a good idea.
We can have that conversation once the market breaks support on a weekly chart, because then I would agree with you. Walmart is a safe haven type consumer driven company. Amazon is not. Amazon is a very, very aggressive company. Excuse me, you go through a bear market, Tim. Walmart has the ability to do actually fairly good in a bear market versus Amazon, which will get absolutely crushed in a bear market.
Yeah. Noah, Walmart earnings. Do you ever trade Walmart, by the way?
I have, yes. I actually have become more and more a fan of Walmart because as I see it, they are the one brick and mortar retailer who's adapting the best to the online model. Whereas others, like we mentioned, you were talking in our prep conversation about other, previous brick and mortar giants
Sure.
like Penny being worth a buck because they haven't adapted. Toys R Us going out of business, those types of things.
Well,
But
look,
Walmart, they're doing the right things.
that's an amazing point here, Matt, because in the 1980s, J.C. Penney was as big as Walmart, I would believe. I don't know that. I don't know the exact numbers in
No,
terms
they
of
were bigger
revenue.
at one point.
And J.C. Penney is now $1 a share. Walmart is killing it, making
$1 a share. That's just the listed price. J.C. Penney is 0 per share.
Would you take stock for 30 cents?
I
if you
wouldn't take
couldn't
stock
sell it?
for. I wouldn't take stock for 1
Tim,
cent.
I wouldn't buy it with your money.
Have you guys, when's the last time you were in a J.C. Penney?
When my wife made me go to Sephora.
Oh, there's Sephora
Like you actually cut
inside.
through the J.C. Penney to get
J.C. Penney owns Sephora.
Oh,
Is
do
that
they?
right?
It's their only. It's one of their only actually brands that actually generates revenue for them. But Noah, you were making this point we talked about in the pre-production for the halftime show here. But you look at companies like Sears, J.C. Penney's, Toys R Us that all failed to kind of evolve in an ever-changing economic and technical condition. Walmart, I've had concerns about Walmart over the last 10 years, having them be able to do that. But I mean, if you had any concerns coming into this earnings report, or Walmart saw a 40% increase in online retail sales, guys, quarter over quarter.
And they've got the infrastructure already built, and they're doing interesting little things. Like they converted in my neighborhood, they converted an old Circle K into a drop ship, where it's like where people can order their stuff because there's not one close to my home. But you can order your stuff and go pick it up, and there's something about that still getting it the same day. I think their marketing's good. I think that getting something same days is and Amazon's getting better at that, but they don't have the infrastructure Walmart already has.
There's still that desire though, Noah, from a human condition to walk into a store and get that though, right?
Right. Get it now, and then you can order it online and go pick it up. So it's kind of getting that convenience factor, or they can have it shipped to your door same day. And so they're doing things, I think, that makes them, where I've looked at the brick and mortar, that retail apocalypse that's happening across the world, not just in the U.S., but it's kind of a worldwide phenomenon where our shopping habits are changing, but they've adapted to the point where they're getting the best of both worlds. They still get the people who want to go buy something in person, and they also get the people who want to buy stuff online. So
they sold over $100 billion in that quarter. They beat earnings per share, forward guidance. But again, kind of what Noah was talking about, being the one brick and mortar store that has evolved fairly good and efficient in this online world. Walmart saw a 40% increase in online sales. That is a spectacular number. Walmart's up 10%, guys. Walmart doesn't move 10% on earnings. It doesn't.
Well,
this is a rock star earnings report for Walmart.
Yeah, they killed it. They absolutely killed it.
I still prefer shopping at Target, but
That's why you prefer shopping at Target, because you call it Target.
Exactly.
Yes.
Target made our
you and my wife
25 watch list, by the way. We actually ranked Target as a better stock fundamentally. There's no doubt about it. I think that if they had the same covered call return, Matt, you could have a debate about that at this point.
Walmart was on the list for a couple of years. We removed it because of volatility concerns, not because of fundamental concerns. When you're doing that Tackle 25 covered call list, you have minimum standards and you have to go through certain techniques, the criterias. One of them is you have to be able to get at least a 2% return on the covered call, selling at 0.40 delta 30 days out in back testing. And, when we were looking at Walmart coming into this year, you're getting 1.2, 1.3% ROI on the covered call, which is good for a dividend paying covered call system, but that's not what the Tackle 25 is. The Tackle 25 is a growth and cash flow system. And so because of that, we just had to remove Walmart at Target, because we're getting 2.4% on Target, 1.2% on Walmart, and nothing to do with the technicals or fundamentals, right?
Yeah. Just comes down to those option premiums. And that's one of the reasons in the past I haven't traded Walmart a lot is it's just more like a big blue chip, low option premiums, but I still think it's a big player.
Hey, listen, that volatility could increase to the point we can do some covered calls on it if Walmart starts doing a lot better from an online retail perspective.
Yep, that's for sure.
Well,
online retail is more aggressive than brick and mortar.
So you got Amazon, you got Target, you got Walmart. If you had to pick one as a buy for Amazon. The rest, you'd still go Amazon. Tech is so strong. Obviously, it's an easy one. If the market stays strong, Amazon should do well. If it comes down to, I guess, market.
No, I mean, okay. If we're at the top of the market right now, okay, I'm picking Walmart because Walmart's a little more safe than Amazon is. If we're bottoming out in the market 2.5 years from now, I'm picking Amazon because Amazon will have more growth in front of it.
Interesting. Cody, let's get that poll on Twitter and see what our halftime crew thinks about it. We got to look at Deere earnings here, Matt. The one company that is going to have earnings tomorrow, which is on my watch list, my personal list. I've been watching Deere, trading Deere for years and years and years. Liquid, big, major company, major brand, and I like tractors, Noah. There's nothing wrong with tractors. Any expectations here? Any play here? What's your analysis, Matt?
Let's have Noah do this one.
It's kind of got that descending setup, and I think the tariffs and that type of stuff hurt a company like Deere and Caterpillar, where the majority of their sales are overseas, outside the U.S. I mean, they're still going to do okay inside the U.S., but that strengthening dollar might be a big factor for them.
Yeah. At this point, I'm not thinking about up or down, obviously. Whenever I go into an earnings report, Matt, first thing I'm going to do is look at volatility and think about a bi-directional trade or a neutral trade. I'm looking at Deere and for MMM projection on Deere, the expected gap.
MMM projection is $6 on a 137 company. You're looking right around 4.5%. So what was that other one of 4.5% we were looking at? They're all in that kind of range.
Yeah.
But 4.5 range, you're talking, $6 range, you're talking anywhere from 143 down to 131. So it doesn't expect a real big movement. It's not like the VIPs. We're looking at John Deere, a very established, fundamental company that, is very liquid, massive blue chip company here. So the market maker move is right around 6 points, coming back here to this first one here. Market gaps goes from 146 up to 155, about a 9-point movement on that day. Real kind of a muted response on this one. The third one ago, you're looking at a gap range of 140 up to the top at 146. And then on the fourth one here, you go from a gap range of 124 down to 116. So 10, 6, 8, and let me just get the exact one here just to, make it look. And you're talking somewhere around 3. Market maker moves pretty good on this.
Mm-hmm. Mm-hmm.
I don't see any reason to say that market maker move is not a legit number.
No, I think it's a legit number. By the way, I always think they are. It's a reflection of what people are buying.
Sometimes you find mistakes.
Yeah, well, and that's where the trades come in. When you think you found a mistake,
when you have an edge,
trading edge. That's right. I don't know if I'm going to make any kind of play on this here. I do like the established number. So then it comes down to, well, could I backfill maybe some kind of range and do an iron condor, short strangle, something neutral? I don't know.
You can always pick a strategy here and play the strategy. I mean, inverted butterfly doesn't have a lot of risk, has a lot of management techniques to it. But again, if you don't have an edge, it kind of feels like you're trying to force the action.
Sure. Yeah, that's where it feels right now with Deere. But, where a lot of my interest is going to come in is because of the sensitivity of the industrial sector. If Deere has been showing that in their actual earnings and results, it could have a bigger than expected gap, Matt. It goes back to what Noah's talking about a little bit. Obviously, we're going to see the reaction. We're going to read the report. I don't know if I'm going to make a play on it going into earnings. I don't think so.
Yeah, I don't feel the desire.
Yeah, I don't see it either. Guys, tomorrow is Friday, last day of the week.
Apple.
Oh, Apple breakout would be.
You miss Apple.
Well, I didn't miss it, but in terms of trading it.
Yeah, we didn't miss it, but I mean.
I've been saying this for weeks. We did a coach's show the day after earnings, Matt, and I literally went off on a rant for 60 minutes about how good Apple is, how strong it is. We talked about it on the podcast about how it could catch up in multiple and have tons of upside if it has it. We've gone through it on the halftime report about this high base breakout. here we are triggering and showing. There's an old mindset that was taught to me, buy high, sell higher. And I know the instinct of many traders to pass on signals like this, and I'm sure a lot of people missed it. How do you interpret this, Apple? Because to me, it's just incredible.
Strong strength, amazing. I mean, what do you want to say? Yeah, it's a picture perfect high base breakout on a company that is one of the best companies in the world. And I love what you said earlier today, Tim, when we were looking at Apple in our pre-production meeting, and you basically said, if you're not trading this, you don't like money.
That's true. I've been all about this stock for too long, and the earnings killed it, and the company's killing it, and they've got plenty of room to catch up. I get it, and you can't chase on emotion, okay? And that's what it might feel like if you're just hearing two guys talk about a company, you go out and do something on it. That would just be an emotional reaction. Put it on your watch list and build it.
Put it on your watch list, trade it, virtual trade. I mean, you should never, ever blindly go trade somebody else's analysis, right?
Mm-hmm.
That's what it is. You know, the simple truth is you don't even know like how we're trading it, where we're placing stop losses, how we're managing it. You have to go do your own research, and if it fits your portfolio design, your risk personality, and you're not over leveraging yourself based on your other portfolio design, then yes. Okay, the way you use this is you take these things and you go apply it to your own portfolio with your own systems, your own responsibility. And again, that's another disclaimer, and everybody knows how much I hate disclaimers, and that everybody hates listening to disclaimers. But the simple reality is you got a lot of people out there in the world that watch these types of things. And I remember I put a video out there on YouTube one time on a covered call, Tackle 25, just basic video. And some guy went and traded it blindly, lost money on an earnings gap, and basically complained about it. And I just said, why would you ever hold that through earnings? Why would you buy a put option? He goes, well, your video didn't show that. And I'm like, oh my God, you've never done a covered call and you held one through earnings just because a 10-minute video didn't teach an entire system? It's just so, you know, sometimes as an educator and from a liability perspective, you just want to make sure that people are aware that you have the responsibility over your own decisions, and you have the responsibility over your own money. And if you make money, that's on you. And if you lose money, guess what? That's on you.
Good catch by Jasmine here in the chat, one of the captains of the halftime crew. Jasmine, awesome. Every day. I love it. Take a look at Applied Materials, Tackle 25 company with earnings tomorrow. I don't have any current trades on them, but they do have earnings coming out. Same things we've been talking about, obviously. 816A, and that's not tomorrow. That's today after the bell. If you own a position, you probably need to hedge and protect. Like
we could do the same thing we did on the VIPs, right? Yep. It's the same thing on the VIPs. You go in there, you build your trade in the risk profile, and you buy enough options to where you feel like you're comfortable on the risk option. But you got to go into these Tackle 25 stocks, guys. There's a reason you're getting 3.5% on them. They do have a little bit more volatility than a dividend paying covered call system does. And so not every one of them you have to do this, but if they are a volatile company that has the ability to move quite dramatically, then you have to look at potentially buying insurance. Now, Applied Materials is only supposed to be gapping right around 4%. That's not that big of a price movement. If you look at this historically here, the first gap goes from 54 all the way down to 50. That's a $4 movement. Second gap right here sees about a $2.50, $3. We'll call it $3 there. On the earnings movement here, really kind of a muted response and a muted response here. So, you know, Tim, Applied Materials is a fairly large company. It's a very liquid company. It's expected to move about 4%. I don't see really, you know, big movements coming out of the earnings. But at the same time, I do not own Applied Materials. It's not one of the TAC 25 stocks I do cover calls on. But if I did own it, I would insure the company because earnings are so crazy, you know, when it comes to the unpredictability of them.
You know, and Cody, for tomorrow's prep, put AMAT and Deere on there. We'll come back and review what the actual gap was on the earnings. Guys, thank you for being here for our halftime show. As always, love doing it. By the way, you know, sad moment from, you know, the music world, Matt. You see Aretha Franklin died? I know she's
I did not see that.
Life,
I saw she was put in a hospice a couple days ago. I did not see she had passed today. That is sad. She's an icon.
Well, and frankly, I love that music. Diana Ross, The Supremes,
It's some of my
Aretha
favorite
Franklin.
music.
Oh my God. I mean, Motown.
Oh,
There's something about Motown. If you
beautiful.
hate Motown, you probably don't like people.
Yeah. It's like if you don't buy Apple on the breakout of an all-time high, you don't like money. If you don't like some jazz and some Motown, some blues and whatnot, yeah, you don't like people.
Yeah, I'm gonna put Aretha Franklin on. One thing when these
Lovely Day Radio will be on today. There's no doubt about that.
Lovely Day. Is that your boy
It's
Bill
Pandora.
Withers?
No. Bill Withers, great. Al Green, Ray, all those guys, they're amazing. But no, it's just Lovely Day channel on Pandora plays all of that type of stuff.
I think, yeah, that Bill Withers song is Lovely Day. So that's probably who they named it after. And then it's got all those guys that fall into it. I'll check it out.
Yeah,
I'll check it out.
On there. It's real good.
Sounds good. All right. Dancing in the office today.
Tom Green was the
comedian.
Al Green. I cannot believe I just called Tom Green out. I cannot believe I called Al Green Tom Green. I feel ashamed. I'm glad Bo Moody's not watching this right now.
I got nothing against Tom Green either. I thought he had a very unique angle there back in the day.
I watched him. So, anyways, from the Tackle Trading Halftime Report and Show, guys, thank you so much for being the best part of Tackle. Thank you for being here. Hashtag Team Tackle, hashtag Halftime Crew. Let's get out there on Twitter and let's communicate in between sessions on Twitter. Thanks, guys. Enjoy the day. We'll see you tomorrow.